Today I want to talk a bit about planning, specifically budgeting or projections. I meet a lot of small business owners that are simply wearing every hat. Taking the time to sit down and build financial projections for their business is something that often just doesn't get done, right? And at that point, they're working really hard, putting in a ton of hours, but are they doing the things that will allow them to arrive at their financial goals? And just exactly what are those goals? So if you're like them, you might be feeling that building financial projections is just too daunting of a task. Well, it really doesn't have to be, okay? Sure, you can certainly aspire to build complex financial models with various scenarios and contingencies and all sorts of analysis. But the basic goal of a projection is to give you a tool by which to judge your progress over the next year, 2, 3 years, and to establish the financial goals for your business. So you really don't have to get too complex or fancy to achieve those things. What I'm going to go through with you here is a quick run through of how to build a basic financial projection for your business.
So what we're looking at here is the basic P&L, which is really the first step in creating a budget, right? You want to look at what is your P&L or income statement going to look like over the foreseeable future. And so what you're going to do is generate that out of Peachtree, QuickBooks, whatever your accounting system is, and you want to export the P&L into Excel because Excel is generally the easiest place to build a budget for moving forward. Everybody has Excel, so easy to use. You'll recognize this as a basic P&L. You've got some income line items, you've got your cost of goods sold categories, you've got your various expenses, ties out to net income at the bottom, right? So you want to run this for a couple of historical periods. So we're in 2011 right now. You might want to run 2009, set that up in here. You might want to run 2010, set that up in here. And then the interim financials for the current year as well. So you can see I'm showing the first quarter of 2011 here, right? And what that's going to do is give you a baseline for your historical costs, as a percentage of revenue, what your costs and expenses are, so that then you're working with a baseline for moving forward. From there, you really just want to set up month by month, moving forward, exactly what your P&L is forecasted to look like. So we know we've got the first quarter of 2011 in there. So then we might have April 2011, May 2011, so on and so forth. All the way through the end of this year, for example. And then we're going to plug in all the numbers, income, materials, expenses, go through and plug in the forecast. So you might look at income and say, well, we're going to be about, $200,000 a month, we think, from here on out, the rest of the year, right? So there you go. You've got that. And then you're going to go through, you're going to plug in all your material costs, your labor costs, any of your direct costs, direct expenses, all of those things. You go through and plug things in. You got to, put in anticipated depreciation and, plug in all your payroll numbers and things of that nature for all these periods moving forward. Generally speaking, you're also going to want to do a couple more years, but you don't necessarily have to set it up month by month. You can. Some people like to set it up quarterly from there out. So you would have a total 2011 column over here, and that would sum all of the line items for 2011 plus the interim that's actually happened already to give you your totals. It's important that you also show your costs as a percentage of revenue so that you can identify exactly where you're seeing gains or losses in terms of percentage of revenue of cost and expense accounts, right? So after you go through all of these, you're going to have a lot of numbers in here, right? And so then you might have something like this. You've got your projections for 2011 lined out over here. And you've got various revenue accounts. You've got your costs again, as we discussed. You've got materials. Any cost account that's on your P&L, you're wanting to project it moving forward, right? So you really gotta, you can't just duplicate what you did in the past. You got to look at it, analytically and think about, okay, so for material category 7, how much are we going to spend on a monthly or quarterly basis moving forward? And at that point, you're really looking to forecast exactly what you think that's going to be. Now, one of the benefits of forecasting also is that you're setting up goals for improvement, right? Now, you don't want to just repeat the past. There's always room for improvement. So let's look at a good example here. Materials. Wow, look at this. So for 2011, the forecast, we're showing 31.6% of revenue, right? So what that 31.6% represents is the proportion of these materials to the total revenue is 31.6%. Now, where the analysis comes in is you might look at this and say, hey, look, in 2010, that was only 23.8% right here. What's going on that's causing our materials to increase so much? And is that acceptable, right? What can we do to bring that back in line? Things of that nature, right? So it's not just setting up the numbers, right? Because too many people will put together a projection and then put it away. But it's about looking at these projections and determining what are the initiatives that we need to put in place to get those materials down, right? And if you just arbitrarily decide, well, we're going to just change the percentage to bring it back down again, and we'll figure out how to do it. A lot of times it just doesn't work unless you have really purposeful initiatives to attack those numbers and get those costs down where you're delegating responsibility for line items. It just doesn't happen. So you've got your 2011 projections set up here. And then you might look at some actuals as you move throughout the year. So you can see, we've progressed further into the year. So we have current actuals now for a wider period of time, such as, January to May. And then you want to update this on a monthly, at least a quarterly basis to see how your actuals, like this column, are doing versus your budget, right? And then what's the variance there? So you can see 23%. And that's the direct labor costs divided by the revenue or income, right, was 23%. Now, we had only budgeted 14.48%, right? So why the big increase? Why is that going up? We need to get to the bottom of that because that's a huge discrepancy that's impacting the profitability of the company. So on and so forth, going on down the line. It helps to highlight good things in green, bad things in red. These should certainly be red, not green, right? This one, would be green, not red. And, that's a good example of why you want to do this, right? So you can see here, wow, this material category was 26% of revenue, right? Whereas we budgeted it to be 31. So we're actually doing much better than budget there. So those are things you want to look at and understand. So you're understanding your costs, right? So that's pretty much how you do it. A lot of times, what I recommend people to do is to go out 2 or 3 years with the P&L, just to have an understanding of what your long-term goals are for the business. How do you want to grow the business? And then from there, you really have to tie it out to a projected balance sheet and cash flow. If your business is going through sudden changes, or even more long-term changes, it will have an impact on cash flow. Certainly, growing from $2.1 million in 2010 to $2.7 million in 2011 is going to have a big impact on your cash needs. That's 30% growth ballpark. So you don't want to go into that with your eyes closed in terms of your cash needs. You really, really, really have to put together a budgeted cash flow that shows on a month-by-month basis, weekly, moving out 13 weeks for the short term weekly, and then monthly from there on out, exactly what your cash needs are going to be so that you can anticipate shortages before they happen. So in a nutshell, this is pretty much the format that you'll want to end up with. You have to export a lot of data from Peachtree or QuickBooks or whatever system you're using. Copy it all in here. You'll have to run a few different reports probably to line this stuff all up, but then you've got a really good basis for putting together projections and then tracking your actual performance against these projections to determine a variance, and then that's what gives you the insight into where do you need to focus on improvement within the financial side of your business. So again, the goal here is really to understand how can we improve, what needs to be improved, what are our goals, what are our obstacles, and you don't have to get too fancy to do that. So setting up something like this can be straightforward. If you know, a couple hours of time to put something like this together, and you'll have a really good tool for measuring the profitability going forward of your business.